Hello traders and investors, Will back here with another one, coming to you with a Thursday market recap. Hopefully you guys had a decent day in the markets today, in spite of a very large sell-off in the SPY and the QQQs. The very polarizing AI trade and the AI fears continue, as the paradox of AI is front and center in the markets right now, of course. On one hand, you have AI revolutionizing the world and helping so many companies have productivity and efficiency gains. But on the other side, AI is destroying those very same companies, it seems like day after day. And even the companies that are enabling a lot of these AI models are also facing severe sell-offs. Google and Microsoft, right? Two of the companies, and even Amazon and Google with direct investments in Anthropic, they're coming down. And Microsoft with direct investments in OpenAI, another leading frontier model, down perpetually as well. So the companies that are enabling all these AI changes are down. The companies that are supposed to benefit from all these AI changes are also down. So it's a very, very polarizing market right now. And we've been talking about this for the past 3-4 weeks. It seems as though since the month of October, the market just can't decide on which direction it wants to take. The S&P is roughly flat over the course of the past 5-6 months, and the QQQs additionally as well, flat with a light downside bias. So in today's video, we got a lot of things to talk about. Unfortunately, I will not have the time to cover earnings today. I do have a flight to catch, so we'll be doing something a little bit different. Today, we'll spend a decent amount of time talking about some news headlines, more AI destruction as several other sectors fall victim to new AI fears. We'll be covering a bit of news and also recapping some statistics, because there's been some very, very big dispersion in the market right now in terms of the names that are winning or up year to date and the names that are losing year to date. And some statistics are very interesting. You haven't seen this in a very, very long time. After that, we'll of course get into our technical analysis, take a look at the SPY, the QQQ, and our minor sectors across the board, and get a sense of where the money is actually flowing into, and whether or not we should be flowing into those sectors as well, or buying the dips and everything that's been selling off in a very large fashion. Thereafter, we'll be taking a look at our big tech list down here, as it was a very negative day for big tech today. Apple down 5%, and for the most part today was once again a day where you did not have any major news catalysts to contribute to these declines. As a matter of fact, when we started off the day in the overnight session, we were actually quite green, and the markets were looking good for a small gap up open, but a gap up open nevertheless. And then we kind of just at the open and into the 10:30, 11:30 a.m. session, really dropped hard and never really covered on the SPY and the QQQs as well, right? Big flushes, a lot of large volume at the open, and then it just never really recovered either. So we'll be taking a look at these big tech names and derive whether or not there's still great buying opportunities, or whether we should once again maybe just stay away and let the market play out. And then at the very end of the video, we'll be spending a lot of time on this list of biggest gainers and losers. So many companies on this list have reported very strong earnings, but yet again, they too have been significantly hit to the downside. Some names had some good performance today. As you can see, Walmart up 4%, SanDisk up another 5%, but the list of names that had a greed session were very limited. So without further ado, let's jump right into today's action. Should be a very interesting and fun video, talking about some of these same themes that we've been discussing here since the start of January, when we started seeing some of this rotation happen, and now this rotation kind of accelerating to the downside. So in terms of today's action, the SPY down 1.54, the Qs down 2%. Fear and greed right now is sitting at a 37 read, into the fear category again. After hesitating here in neutral for the better part of the last 2 weeks, we're now back into the fear category. If you take a look at the heat map, it was not a very pretty day. Apple down 5%, no news there whatsoever. A lot of big tech, once again, suffering big losses to the downside. But not only them, even some of the big financial corporations rotating heavily to the downside. You'll see some of the banks here. I mean, Wells Fargo, JP Morgan, Bank of America, all down 2, 3, or more than that. Some of the credit card companies down as well. Your asset managers, such as Blackstone, BlackRock, etc., a lot of them down too. And if you take a look down here, I mean, the bottom half of the market was doing very well this morning, but even they too started losing some gains into the end of the day. Consumer defensives still remains a very hot spot of the market. Walmart, Costco, Coca-Cola, Procter & Gamble, a lot of those names performing very well. Industrials, a very mixed day. You did have some names that were higher in the defense category, but a lot of high-flying names such as Caterpillar and John Deere. Look at these charts, right? Very strong moves to start the year on John Deere and Caterpillar. There's Caterpillar. Here's John Deere. Also suffering some pretty big retracements, a very large red candle on some of those names today. And towards the downside here, Energy, which was a very popular trade to start off the year as well, also having a pretty big day of declines. The only real sector that was virtually green across the board, utilities. Moving on to the one-day relative performance, you can see today's destruction even better to where only XLP and utilities, so staples and utilities, actually held it up. Everything else really severely hit to the downside. Basic materials, technology, energy, financials. So some of the boring trades on the 1 week relative, like basic materials, utilities, industrials, right? A lot of those, except for utilities, down on the day as the S&P just kind of really started to hit everything to the downside towards the end of the session there. On the 1 week relative, you still remain fairly balanced, which is somewhat awkward to see, but communication services, cyclicals, and financials, some of your worst performers. And funny enough, technology is actually still your third best performing sector, but we know it hasn't been all of technology. If I put this back on a 1 week relative basis, you'll see that most of the gains have been really concentrated into semiconductors, right? NVIDIA, Broadcom, Micron, AMD having some nice upswings over the past week or so, but giving some of that back today, and some of your semiconductor equipment manufacturers and memory names also doing quite well. Microsoft, Oracle, Tesla also not doing too poorly on a 1 week basis, but then again, today was another day where they kind of dropped and gave back a few of those gains. So a very, very polarizing market for a very, very polarizing narrative. And before we cover more in terms of technical analysis here, guys, we're going to talk about a few key pieces of news today and once again recap the narrative that's going on right now. It's very funny, the paradox that's in play in the markets, right? Whereby the companies enabling AI are going down. Now, some people could argue that that's because of the amount of free cash flow that's being invested into CapEx and things of that nature, but you would expect, right, that at least they would be able to catch some bids if AI is taking over the world. At least some of these the companies that are making some of the frontier models, they would be going higher in aggregate, but that is not the case, unfortunately. Certain companies within the context of data centers, such as your second order AI plays, the connectivity plays like Vertiv Holdings, etc., companies like ANET, which reported earnings today, they haven't been doing too poorly, right? Everything inside the data center, the cables, the liquid cooling, the heat, the heat sinks, anything from generators, right, or fuel conversion tools, etc. Everything inside the data center has been doing well. The data center players themselves not doing so well. So please keep that in mind, right? So what we have right now is a bit of a sentiment paradox in terms of, several companies that are enabling AI. They're going down, but also AI is just destroying companies across the board. And the latest victims of those today are these. AI freakout claims new victim as logistics stocks fall. Next up for the AI freakout are logistics stocks, which had the embarrassing distinction of being knocked down by a former karaoke company. They sank Thursday as investors rushed to dump shares amid ever-growing fears that AI is going to take down more and more industries. You had some huge declines on some trucking companies today. If you take a look here, C.H. Robinson, XPO, Old Dominion Freight Line, all very boring companies. They're not really supposed to move like this. And it all had to do with this company right here, Algorithm Holdings, saying that its semi-cab platform and live customer deployments was helping its customers' internal operations to scale freight volumes by 300 to 400% without a corresponding increase in operational headcount. You know what's funny about that company right there? Algorithm Holdings, right, which was very popular today in the news cycle. It's a $2 million market cap company. They used to be a karaoke company, and they're bringing down companies worth billions and billions of dollars. Just goes to show you how polarizing the sentiment is across this entire trade. People are just shooting first and asking questions later, just dumping absolutely everything. There is probably a lot of very big players that are capitalizing on these news headlines and going massively short with tons of money, and there's just nobody there to currently buy the dips. Moving on a little bit further, we had another scare yesterday into today as well, and this one was for some of the commercial real estate players. Real estate stocks sold off hard Wednesday, but also today, CBRE and CWK down 12% yesterday, their biggest drop since 2020, on fears AI tools could automate parts of leasing and deal workflows and eventually pressure fee-heavy, labor-intensive models. Take a look at CBRE. This stock as well is not supposed to move like this. It's a massive move, 20% in the past 2 days. And if you take a look at Cushman and Wakefield as well, right? Not supposed to move like this. Very, very volatile moves. Any single AI headline is crushing sector after sector. SaaS companies, it's an everyday thing. But, today was the trucking companies. Yesterday and today, some of the real estate companies. So they're all getting hit. It seems as though, right, this is just tinfoil, of course, but it seems as though there's a cohort of big players that just rotates between sectors and just flushes absolutely everything in an indiscriminate fashion. That's exactly what you're seeing right now. Just really indiscriminate selling across the board off of some of these AI fears. And what's very funny about all this is when you think about AI conceptually, you might notice the price action recently in terms of the rotation, right? If you take a look at a year-to-date basis in terms of the rotation, right? It's kind of rotation into value and defensive names, which would lead you to believe that the market is approaching a more risk-off environment. But then again, they're selling off. Then again, every single day we hear about new AI advancements that are taking over large industries. So which one is it? Is the market afraid of AI, or is it loving AI? The premise of the AI trade, just to begin with, right, is a risk-on concept. But then again, you see the positioning here in the markets, and it's going risk-off. So once again, very polarizing effects in the market right now. If you take a look, the XLK sector tech ETF has the highest short interest rates, or the highest short interest since 2020. That's not easy to do, but what is really notable here is the speed. It really started at the beginning of 2026. The speed of how much this short interest has built up is quite staggering. Now, we've been talking about this over the course of the past week and a half, how short sellers, especially a lot of hedge funds, but big money, has been making a ton of money selling off certain key industries, software, and then very niche sectors of the market on AI headlines. And that's why you're seeing such violent and volatile drops across the board. So the speed that this short interest build up is quite significant. So please keep that in mind, right? There's a lot of short sellers in the market right now, and there's just no big players stepping in on the other side to stop them. They're just pretty much moving these things unobstructed for the time being. That is very significant in my humble opinion, but it could eventually squeeze the other way. But you're going to need something in terms of a big catalyst, whether that's NVIDIA earnings or whether a few big investors step in, like we saw Bill Ackman yesterday with his disclosure of the Meta position, which he built in November. But even that wasn't enough to move Meta overall. So you're going to need something, so a cohort of people to step in and kind of stop these guys dead in their tracks, because as we've been saying, right, they're going for the liquidation breaks. They're going for the margin call breaks. We referenced how much margin was in the markets last week, or even at the beginning of this week, when we conducted our analysis of why the markets are dropping in such a ridiculous way and why nobody's there to buy the dip, right? A lot of people are just getting liquidated, and it started with the silver and gold liquidations just a few Fridays ago, and it's kind of carried into various subsectors of the market seemingly every single day. If you take a look here at the once again, the spread here between the IVW and IVE. This is the iShares Growth ETF over the Value ETF. And you can see I've highlighted a few moments in time over the past year and a half, right? We know that value's been outperforming growth for, let's just say, the past month and a half, but more specifically, you'll see it really accelerated in the past 2 weeks of trade, and that is without any real negative headlines across the board, right? Usually you would expect a tariff headline or something out of left field in terms of macro, like a disastrous jobs report or a disastrous inflation report or something of that nature, right? You haven't had that. It's just been normal price action and normal rotation. If you take a look at all the 4 times that I've highlighted on this chart, you'll see that when we crack down into these oversold conditions on this IVW over IVE, usually that tends to mark a local bottom area. It doesn't mean that it's the exact bottom, but it does mean that you may be able to see a flip coming in the near-term future. It does not mean technology cannot continue to be unfavorable here for the next few days or maybe the next week or so, but it does look as though the market is trying to flush out a lot of the excess in tech right now, one subsector at a time, and possibly you will see some short covering and possibly see some rotation back into some of our favorite names in terms of technology, right? Because a lot of these names, guys, I mean, you take a look at the year-to-date performance. Walmart's up 19, Costco's up 15, Procter & Gamble's up 12, Coca-Cola's up 13, Pepsi's up 16.5, Caterpillar, John Deere, they're crushing it. I mean, Caterpillar obviously has those big diesel generators for the data centers and whatnot, but John Deere up 28, Lockheed Martin up 31, the oil companies up 20%. It's been a while since we've seen that, right? Sure, you got some pockets of strength within year-to-date gains on some of the memory names, some of the semiconductor names, etc., right? But some of these gains, guys, are quite substantial, right? A lot of these companies putting in gains that normally they don't even see in a year, and they've done it in about a month and a half at this this current point as the value rotation is really significant. So pay attention to this crossing. Add it to your watch list, IVW over IVE. Now, moving on a little bit further here, guys, we're going to talk about the dispersion that I've been bringing up, right? And you do not usually see this. As you can see, the S&P is roughly flat over the past month, but the average stock moved 10.8%. The dispersion spread at the 99th percentile over the last 30 years. Usually, you do not see this unless you're in times of very large turmoil in the markets overall. You can see that when the dispersion started happening, guys, stocks were moving a lot more violently than the indexes, and pretty much in the times of the global pandemic or in the great financial crisis or in the dot-com bubble. But as of right now, normally what you do see in tandem with these moves are large drawdowns, right? The dispersion is just how much a stock is moving against a index in terms of absolute moves. So the SPY could be dropping like 2, 3, 4, 5%, but then some stocks would be moving 10, 15, 20%, which is what you can possibly see in a very rapid sell-off like 2020 or 2008 or 2000 and 2001 type of stuff, right? But that's not what we're seeing right now. The indexes are largely very close to their all-time highs. So you do not usually see something so awkward. It's a very, very challenging market right now. I'll be the first to admit that. And then you can also see something like this. Something else that you haven't really seen is, as this person referenced, over the last 8 sessions, 115 stocks in the S&P have declines of 7% more in a single day. The average drawdown of an index, when that is supposed to be the case, is 34%. Right now, we're about 2% below the all-time highs. So you can clearly see something is going on behind the scenes here. And I do believe it is the big money, guys. They are just choosing, they're targeting upon their basically the short sellers, right? They're just targeting certain industries here and there around these AI headlines, and they're just having a field day with it. And arguably, they are getting away with it unobstructed, as we've been talking about, right? A lot of algorithms at play right now. You can see that usually when we have that, 115 or more stocks fell at least 7% across a rolling 8-day window. I mean, look at the times when you usually get this, right? You usually get that when you're in full collapse mode on the indexes because there's something severely wrong with the macro. Once again, not the case. The last time the big tech bubble blow off in 2001, right? Or 2008, the depths of 2008, or a very rapid period of sell-off such as 2020, or the bottom, some of the bottoms of the 2022 bear market, or the tariff liquidation breaks at the peak of the Liberation Day sell-off when you had an everything decline and the SPY was down 20 and the QQQs were down over 20% as well. But that's not the current market environment you're in, which is what makes things so confusing and so weird overall. Moving on further here, you also have the NASDAQ put-call skew. Look at the put-call skew right now. Some of the put-call skew right now is approaching levels that you would otherwise see at the peak of the fear of Liberation Day, when, as I said, the indexes were down 20 to 25%, or some levels that you were also able to see at some of the peaks of the 2022 sell-off when inflation was at record rates, interest rates were rising super fast, and the supply chains were broken, and a lot of these companies were guiding for negative revenue, negative EPS year over year from the 2021 boom. Very strange market behavior right now. If you take a look here, what's funny about all this is that AI, the one thing that's kind of contributing to a lot of this negative sentiment, is actually driving historic profitability in the market. And we've talked about this. Earnings so far have been very good. The S&P 500's net income margin, excluding financials, is up to a record 13%. If you exclude the Mag 7 in tech, that's down to 9%. So to be honest with you, technology stocks, especially the Mag 7, they are leading to the biggest margin expansions that you're seeing across the entire board in the entire tech landscape, which makes things even more weird, right? If AI is contributing so heavily to profitability and so much to certain growth in certain sectors, then why is it destroying all those same sectors that it's supposed to be helping right now? Now, in terms of other news today, aside from this whole AI paradox, of course, and the volatility that's in the markets right now, you had one piece of news that moved gold and silver in a fantastic way today. Russia considering moving back to the US dollar as part of a wide-ranging economic partnership with President Trump. Per Bloomberg, the partnership would include US and Russia working together on fossil fuels, joint investments in natural gas, offshore oil and critical raw mineral partnerships, windfalls for U.S. companies, and Russia's return to the U.S. dollar settlement system. Now, this did rock gold and silver at the time that that was released, and not so much the equities market, but you can see there's a bit of a violent move here when that news was essentially published here around the 11 a.m. mark on gold. Gold fell about 3%, and silver fell way more. Silver fell about 7.7 and culminating the day almost 10% down before we had a nice little bump up here in the after hours market. So that was one piece of news today that did have an impact on one aspect of the market, but definitely not on the equity side. The damage on equities was largely done at that point in time. Moving on further here, I will remind you, we are in a midterm election year and possibly some seasonality is at play here as well. You'll see the average of all S&P 500 seasonality years is displayed right here, to where usually we have a nice little movement into the first half of the year, and then towards the fall, it kind of evens out before getting that infamous end of year rally. This year, being in a midterm election year, it's a little bit more choppy. Usually they start off the year down January and February, and we have been seeing that so far before recovering into the end of February, into March, into April, and then unfortunately having a not so great summer overall, and then a big end of year rally too. So seasonality perhaps a little bit at play, but let's be honest, right? Even though there is some seasonality at play right here, the story has really been about this AI paradox that the market is facing right now. So keep all of that in mind, guys. It is a very just to sum it all up, right? It's a very confusing market right now, and this market may lead you to believe that if you're invested in some large cap companies with very strong business models, very strong moats, I'm not talking about speculative bets right here. No. Some of the strongest companies in the world with some of the best business models, they have been net down. Large caps have just been very unfavorable this year so far. It may lead you to believe that you're doing something wrong, that you're buying these companies at unfavorable prices, that the business models of these companies are finished, essentially, right? But that's not the case. The market can often be very irrational in the short term, and we are seeing a perfect display of a very irrational market right now. Can you pick apart certain things and say there are a few little elements here and there that the market may be contending with, such as the domination of wars, or such as the labor market, which has been in a no hiring, no firing environment for a while now? Well, yeah, but that's been the case for a better part of the last 6 to 9 months overall, right? There are other key little elements here, such as some people reference the private credit markets, which you did also reference back in October too, but nothing substantial. You would expect to see you would expect to only see such destruction if you had one clear catalyst that was really at play here. One big macro catalyst, whether it be tariffs, whether it be inflation, whether it be interest rates, whether it be something of that nature, but there's nothing there. It's just a compilation of tiny little things with an overall AI black cloud. But it's funny because the AI cloud is both a blue sky, but also a very black cloud, depending on what sector that you're talking about. But more and more, several more, there's a lot more sectors that are falling victim to these AI headlines than are being helped with them right now. So please keep that in mind, right? Not necessarily doing anything wrong by picking up some of the greatest companies in the world. I'm not only talking about big tech, right? It extends far beyond that. We could talk about companies like SPGI. You could talk about companies like Visa and MasterCard, which haven't necessarily been affected by AI or anything like that, right? It's just that they haven't done anything for a better part of the last year. And there's so many instances of this, of very high quality companies, toll booth companies, compounding companies that are just very unfavorable. And, what I get a sense from sometimes when I browse Twitter or Reddit is that people they just want to sell everything that they own and just rotate into the very few things that have been making people money so far at the beginning of this year, right? Rotating into value names that for the most part have been very unfavorable for the last 3-4 years. Some of them, a lot of them only with, single digit revenue growth, swapping out some of your favorite Mag 7 companies or some of your favorite financials companies, et cetera, for the lowest growth aspect of the market to begin with. Now, we've talked about this many times and I'll just recap it again, right? You can view this rotation as one of two things. Right now, the easiest way conceptually to view it is that the market is moving on to risk-off sectors because it either doesn't believe in AI or it doesn't believe in the growth or it doesn't believe in everything risk-on in the markets right now. So it's just taking a very big breather, right? And just rotating into value because it's looking to protect itself. But if that were the case, you would also see a pretty big rally in the bond market, It's just not here, right? Just not here at all. It's been upswinging a little bit, but the fear trade is definitely not not there. And then again, you also have names like gold and silver, which keep getting pushed around. So you can argue that maybe people front ran the safety trade and are just holding the safety trade in gold and commodities and things of that nature, right? But no, what we derived to start off the year is a bit more complex than just the market is moving from risk on to risk off, because this started before we got most of the very big sell-offs in tech, right? This all started mid-December when we started compiling our favorite list of trades and themes for 2026. And at that time, I will remind you, the XLP was down here, all the way down here. Energy was also all the way down here to start off the year, right? And we were saying that in this current environment, energy would be very popular as a resurgence for the energy requirements for all the data centers out there. But not only that, we were saying that XLP would be very popular because it's going to embark into a cyclical environment, right? The safety trade formerly was big tech because they had great cash flows. They're toll booth companies. They make money in all markets. So in 2023, 2024, 2025, there was a lot of discussion surrounding high interest rates, restrictive financial conditions. Inflation was still somewhat uncertain too. And to be honest with you, just last year coming out of tariffs, right? I'll remind you, Goldman Sachs, Bank of America, Morgan Stanley, they had recession odds for the economy surrounding 30 to 40%. And the safety trade at that moment was largely big tech and the AI trade. But now, what we noticed at the end of December pretty much is that because a lot of the institutions had shifted their macro views into 2026, saying, yeah, it could be a very good year because you had a lot of supporting macro conditions for that, right? You had, just to name a few, go in here, very strong GDP tailwinds, strong rate cut and quantitative tightening ending tailwinds, relatively low unemployment, which you just saw the other day, 4.3%, inflation coming down, strong earnings out of Q3, and great earnings projections for Q4, which we did just have very good earnings, the AI megatrend, which is still there, and the $4 trillion in tax cuts, which is huge fiscal stimulus. So we were saying, listen, if the market is more bullish on the macro for 2026 than it had been in 2024 and 2025, if you have removed a lot of the macro uncertainty catalysts, well, you could find a rotation into some of these consumer staples names. I'll remind you, consumer staples haven't done anything for 4 years. Why? Because these companies had no pricing power and you had high inflation, you had high restrictive interest rates, right? Which is why a lot of these companies struggled when the consumer was also struggling. Now, the big money wouldn't rotate into these just because it's scared of the market. No, the rotation initially started when the view cleared up surrounding the macro of 2026. What we're seeing right now, the continuation of this trade, you will have a smoke screen of people telling you, well, listen, it's because the market's going risk off and the market's scared. This whole thing started before any of this was in play, right? And we kind of identified it just because of that cyclical macro rotation, the fact that the market believed that 2026 would be a clear, a more clear macro environment than perhaps 2024 and 2025 was leading you to believe, which is why there was some big money. They were looking for alpha, right? A lot of these names have been held down for a while and, some good risk-adjusted returns when you remove the fear of no pricing power, you remove the fear of consumer spending falling off a cliff, you remove the fear of a recession, of weak GDP growth, right? Well, that's when you can kind of invest back into some of these names that have been bogged down because of all those former fears. So keep that in mind, right? The rotation goes a little bit more deep than just the face value. Oh no, it's risk on to risk off, and now everybody's piling into consumer staples. No, that started before any of this started happening in terms of tech. So very long introduction, right? Many of these concepts we talked about earlier to start off the year in terms of the rotation. I made so many videos in January before any of these sell-offs, before big tech reported earnings, before any of this started happening with AI and things of that nature, right? We were saying, listen, XLP, energy, utilities could be very interesting trades because rates are finally coming down. The consumer has a more clear runway in terms of the path for growth. GDP is accelerating. You got a whole lot of fiscal stimulus, right? So this may be the time where the big money chooses to finally give sectors that haven't been loved for the past 3-4 years because of the former concerns. They might be giving them some love. And that's exactly what happened, right? Before anybody started talking about a flight to safety trade overall, right? The money had already been deployed at that point. You can clearly see from the chart when they actually started building those positions on that. And also the energy trade was forming a beautiful base. And we were talking about XLE leaps back here, right? So please keep that in mind. So very long introduction to present to you guys what's been going on with the markets, some key statistics, and the overall conclusion is that the market right now is very confused amongst a number of different topics, right? It's confused as to what is AI going to help, what is AI going to disrupt, and as best as you can possibly look into these things, right? You just have to kind of wait and see what's going to happen. Are some of the moves extremely overdone? Of course, some of the moves are extremely done, right? You're seeing some legendary companies trade at very low multiples, extremely low multiples. And once again, I'm not only talking about big tech. We're talking about names like SPGI, names like Booking.com for travel, right? Names like in the financial sector as well, such as Visa, MasterCard, et cetera, right? You don't even have to reference big tech. You can just reference so many legacy toll booth companies that have just been getting beaten down and beaten down and beaten down because of AI fears or things of that nature, right? So the market's very confused. Market's very confused right now. And when the market's very confused like this, it can lead to indiscriminate selling. Very indiscriminate selling overall, and a lot of volatility in certain sectors overall. And at this point in time, guys, you just kind of have to, when in doubt, zoom out, right? There's nothing truly that points massive red flags around the direction of the economy. And mostly we know that the market, it can be irrational in the long term, but does follow earnings. The market can be irrational in the short term, but does usually follow cash flows and earnings in the long term. And all the indications are so far, earnings have been great. Expected EPS growth for the S&P this year is in the mid-teens. I just showed you the chart of the profitability of some of these companies as well. The rest of the S&P has been doing quite well, moving to the upside, but especially tech, right? They're leading a lot of the margin efficiency gains right there. So we're not seeing margins collapse. You're not seeing EPS collapse overall. You're seeing free cash flow come down because these companies are investing record amounts into AI specifically, right? So, you can make arguments either way for that. But to say that the market is extremely overvalued across multiple, toll booth companies is necessarily not the case. Are there certain pockets of the market that may be construed to be a little bit overvalued? Yes, but that's always the case right now. That's always the case in any given market, right? But to say, broadly speaking, that the market is displaying massive red flags here, no. There's a lot of volatility. There's a lot of liquidations, a lot of margin calls being issued. There is a cohort of very large players having a lot of fun shorting certain segments of the market back to back, and just nobody there to kind of bid the other side just yet, kind of getting away with it in the process. And we referenced how much money the hedge funds have been making shorting these various aspects of the market indiscriminately since the year began. So you can kind of see, right, a lot of inorganic price action in the markets right now. A lot of big money, big volume, algorithm continuation, and such is the nature of the market right now as we continue to move through this period of, it's funny because I was about to say high uncertainty, but is it really that uncertain? Like, are we that uncertain about AI? Like, AI is very good. It's going to help a lot of industries, but is it going to categorically erase entire industries and entire companies overnight? Well, everybody knows the answer is no, right? But then again, the price action has been indeed acting that way. So it's our job to kind of search through the noise and, kind of take advantage of these very impressive buying opportunities across legendary companies. And once again, you guys know that I am a very big tech investor, but you don't exclusively need to look at big tech. There's so many other very high quality toll booth companies that we reference quite often here that are trading at very attractive valuations with very solid business models. So if you're a long-term investor, there's definitely something for you in this market overall. And it does not imply, chasing Coca-Cola up here at $80 per share type of stuff, right? So please keep that in mind. But the dividend cohort of the market, you have to give it to them, right? Because for a long time, the dividend cohort of the market, they saw no gains. Here's SCHD over the course of the past 4 years. So now it's the dividend investors' time to shine. And, you kind of got to congratulate people because they held the bag this entire time, just accumulating dividends. And now they're finally getting some equity appreciation with that as well. So keep that in mind. I haven't even touched upon international markets, international equities, which have been performing very well too. So, it's not the equities markets overall, guys. I mean, if you take a look, I don't have a chart in front of me right now, but if you were to just reference other world markets, maybe I can pull up a chart for you guys too. Give me a second here. So I got one for you guys. This is another aspect, right? Global equity ETFs. Like if the world was such in peril right now and we're going to a global mass recession, well, you would probably not see such magnificent gains in everything else. So a lot of these other end markets didn't perform too well against the US in the past few years, but we know that they've been performing really well. The only issue is here when you kind of look into the data, if you look into South Korea has been having some phenomenal performance. But when you look at the market cap weighting of the index, right, it's basically like 3 companies. And the same can be said about many of these world ETFs overall. Like a lot of them are highly concentrated into the top 3 or 4 companies of those zones or of those end markets. And as a result, when those companies rise, you're seeing tremendous outperformance as the either emerging markets or international markets trade has been a very popular one. That would not be the case, especially if people were fearful of some black swan global event happening right now. It's just that the US markets are kind of been bogged down recently by a lot of big tech names, but there are some sectors outperforming. So as you can see, guys, right, the market is a very deep place, a very complex place overall, and sometimes filtering through the noise it also requires a lot of work, but that's why I'm kind of here to help you guys out, right? In terms of being able to filter through that noise. I'm still very bullish on the US markets overall. I mean, Canadian markets have been doing fairly well too, but overall, I just do not see any massive red flags. As I said, are there certain key little elements of a bear thesis that are always going to be present in any markets? Yes, but are they overwhelming now to a certain extent that other than seasonality and other than AI fears, are we looking into a year in which we can go into a 20% drawdown and stay there for the next 12, 18, 24 months like we did in 2022? I don't think necessarily that the markets have supporting data for that just yet. I just think it's a big liquidation shakeout right now, a narrative shakeout right now for most people, and it's kind of hard to swallow for a lot of people, especially if you are mostly invested into a lot of the sectors that have just been falling and falling and falling, or flat for a better part of the last 6 months. So keep all that in mind when you're approaching your charts. Keep a level head as always, guys. And once again, we will take things one day at a time as we usually do on the channel. But a very long introduction. I did it this way because I won't be seeing you guys now for the next couple of days. I'll be traveling today and tomorrow, no YouTube video as I am traveling as well. But hopefully you guys can make some sense of what's going on in the markets right now and keep a level head amongst all of this noise, because the headlines right now are very sensational headlines, very polarizing headlines. So just please approach the markets with a level head. Get a shopping list together of your favorite companies, and when they approach those prices, focus on the business. At the end of the day, guys, you're not buying a stock. You are buying a business, and that should be reflected in the companies that you're choosing to buy, right? Don't just buy something because it's down tremendously, right? You can find some software names out there that are down tremendously, but if you do not want to own that business, then don't do it. And I'm talking here to the long-term portfolio investors, right? If you're trading, obviously it's a different set of rules, of course, right? But for the long-term portfolio investors out there, don't just buy something because it's down. You really have to enjoy the business, and only if you enjoy the business and you understand it and you know that it has a very strong moat with large competitive advantages and international network effects. If it's down 25, 30% and trading at some very low valuations in relation to past historical metrics, right? Well, you know that you can indeed buy it, despite the fact that the momentum isn't there, the velocity to the upside in terms of mean reversion is not there just yet. Everybody wants some dips on their favorite companies, but then when the dips come, people either want more of a dip or they just get scared. So hopefully that won't be you during this market turmoil that's happening right now. That being said, that's your very large introduction. Now you guys understand why I didn't want to do earnings. I wanted to spend so much time talking about the current market events because I do feel it's important. And once again, I'll reference this video. I'll make a title that's unforgettable. And if the markets keep dropping, I'll continue to reference this video because obviously I can't do these in-depth discussions, right, about the market psychology, about the inner workings of the market. I can't do it every single video, or, they would be either too repetitive or way too long. That being said, guys, that's it for your introduction. Now, let's actually move into some charts, right? So if you take a look here at the S&P 500, the S&P 500 coming down in a big way, and you can see this chubby little head and shoulders pattern right there. And if we do choose to break down through this area of support, which has held us a lot, especially since the month of December, right? This whole 686 down to 679, you're coming right back down there, 674 to 668, some of the lows that you had earlier on in December, and into some of the levels that we had during the October-November sell-off in the markets too. So keep that in mind. It does appear that you are looking to roll over a little bit right now. In terms of the weekly, the line in the sands are still planted down here at 675. If you lose those, well, you would be heading into a bit of a weekly downtrend, and it could lead us into possible monthly consolidation. Keep that in mind. We've been in sideways monthly consolidation, but we haven't had the downward bias skew just yet. That all changes if you lose your weekly levels right here at 675 on the SPY. There's a few levels of support in the interim, but 12 EMA backtest, guys. Usually when markets get very confused and very volatile and things start selling off left, right, and center, and you go through a bit of a volatility event, a little bit of a liquidation event, for a lot of people, 12 EMA is the area where you're going to look for that fallback. So keep that in mind as we are right now in the, that's not the chart, that's not the chart, that's not the chart. Do I have the chart? Ah, here's the chart, my bad. Seasonality, right? Seasonality could take you through that overall. So please keep that in mind. The same thing can be said about the QQQs right now. So the QQQs, we knew that it was a daily downtrend. Unlike the SPY, they had a nice bounce, 50% bounce from the most recent lower high right there, 50% bounce. We were looking for them to hold this support, and in the pre-market hours and the start of the day, it was looking pretty good, but markets just completely unraveled all throughout the day, and you might just be looking now for either a test of equal lows or lower lows, which would put you 596 down to about 590 overall. The 200-day EMA is not that far away, guys. Not that far away, still about 3% away on the QQQs, right? That being said, the short-term tightening range has now officially kind of been lost, right? Especially if we close the week like this. It's not done yet. Friday, obviously, we had a big day of sell-off last Thursday, which culminated into a very nice recovery day Friday, right? You might remember this big liquidation break here as well on Thursday, on Wednesday as well, right? But now, depends how we close the week, but the weekly is not looking the best. I will admit that right now. And as a result, if you get into further monthly consolidation with a downward bias, 12 EMA is coming up quickly, 579. And you'll see that in most bull markets, because we are still indeed in a bull market, right? You are going to come down here and possibly tag that 580, which would be a phenomenal buying opportunity. And that would put the QQQs down from the highs to that 12 EMA about 9-10%. Usually when you see 10% corrections, there's something going on. You usually get a macro effect or some black swan or something like that, right? Hasn't happened just yet overall, so please keep that in mind. And of course, if you guys want me to talk about it too, some people may argue that, you know, there's a lack of liquidity because there's a lot of hedge funds unwinding the Japanese carry trade for the past quarter or so as well. So many little key elements that are kind of building upon each other, right? But no actual big trigger from the macro. And in my opinion, that's better than worse, right? If you don't have a clear big macro trigger, it'd be a lot worse if you had jobs falling off a cliff or record inflation levels again or things of that nature, right? Which is what we don't have right now. Moving on to financials. Financials just getting washed today because of the banks. Financials down 2%, coming down to support right now, 52, then about 50 and a quarter. So please keep that in mind. Weekly uptrend has now been lost. We know the bulls were trying to make an attempt for it right there, and it was looking good before this week. And now, unwinding the time frames, weekly downtrend, monthly consolidation continues at this point, and now is when the bulls really have to show if they mean business or not. 52 out of 50, they need to hold this key area. They've held it for the last 6 months. That would be to hold it to keep the monthly uptrend intact. So please keep that in mind. So many phenomenal companies in financials right now trading at very low prices, and I'm a fan of buying them. We've covered them, many of them on the channel, right? Healthcare continues to do absolutely nothing right now, still stuck in this consolidation range, so we'll be looking for the range to break one way or another. But, you know, the S&P, if you want the S&P to go up, well, number one, you need big tech. You need technology, but in the absence of technology, you need the two other biggest sectors. You would need financials and healthcare to start playing some ball, and they just haven't been doing it. Healthcare has been holding, but not expanding. Financials has had a downward skew over the course of the past month and a half, and the only aspect of the market that's kind of contributing is this aspect right here, but it's not enough in terms of the weight, which is why you see the downward bias on the SPY. So keep that in mind. We're still looking for a break in either direction. I'd be willing to see a break down on the XLV if it comes to it, right? You're looking for 150 down to 145 for more bids. Moving on to semiconductors right now. Semiconductors down 2% from the highs. Tried to set a new higher on the SMH. unfortunately not able to do it. So they had a really nice bounce. We will see if they're able to convert. If they unwind this entire move at head lower, it's going to look pretty nasty overall, not going to lie, right? But it would still just be weekly consolidation on this ETF that's been having a really great time since the midpoint of December. So keep that in mind. We are still a nice weekly uptrend, but this is your market leader, right? Start getting some big weakness in the market leaders, and you could take another little bit of a leg down. Monthly time frame does remain a little bit extended right now. There are some very good deals across the board in semiconductors if you know where to look, of course. And we've covered many of them on the channel. NVIDIA, Broadcom, right? AMD, Marvell, just to name a few, right? Just to name a few. So keep that in mind. IWM Russell, the Russell down 2% overall today. Before today, the Russell was holding up really well. Amidst the entire AI sell-off and the tech sell-off and the large cap growth sell-off, what's funny is that you had the two opposite ends of the trade. You had the risk-off trades, XLP, XLE, industrials, utilities, but then at the same time, you had the Russell, which was the smoking gun, which is where which is what leads you to believe, right? The rotation is cyclical in nature because the market believes it has a better picture for 2026 on the macro front. If not, you would not see the Russell rally. You'd see risk-off rally, but you would not have the Russell, right? And so far, that trade has been very good, but today, just everything got unwound, right? Absolutely everything got unwound today. So line in the sand level, 255. The bulls tried to make an engulfing move for the daily uptrend reset. Unfortunately, not there yet, falling apart a little bit. And as a result, you may just be looking for further weekly consolidation on the Russell. And that would kind of put you down 251, then about 248, this same area that we kind of left off from, which in all reality would just be a healthy leg of monthly consolidation. But the Russell is looking decent, right? It definitely doesn't look the same as the SPY nor the QQQs, looking like it does want to continue the breakout this year. The higher time frames, at least, do show that. Now, moving on to other minor sectors that we talked about, but I'll talk about them one last time. XLP very strong, but once again, keep a look at your daily RSI, right? Overbought conditions right now, very popular trade. Bulls are in full control. Pay attention to 86.70, line in the sand. If you lose that, that's the end of your daily uptrend and possibly signaling weekly consolidation. I'd be a big fan. That's going to be your re-entry point, right? If you get consolidation on XLP and you come back down to the mid 80s, that's going to be a re-entry. I do think that XLP can be a very popular trade for the next 6, 12, 18 months. Not because the market is about to go into some massive recession or something like that. No, just because it's been out of favor for so long. And I do think the rotations will indeed continue into these names. They will be doing what they were supposed to. They usually do, right? Which is in a nicely broad bull market, you have everything moving up. You don't have XLP being left behind here for 4 years. You know what I mean? Usually in a nice broad bull market, XLP will follow. It just hasn't done anything. So that pullback area will be one to watch if they do offer re-entry opportunities. Consumer retail hasn't been doing much, but we'll talk about it, right? Consumer retail has been an interesting aspect of the market so far. Consumer retail could also be an interesting trade too, whether it's some of the restaurants, whether it's some of the clothing companies or things of that nature. I don't personally invest in those. I personally invest in business models overall. The only couple ones that I own for consumer retail are names like Louis Vuitton or Amazon and things like that, big conglomerate names that control entire swaths of a certain market. But there could be some alpha here in a bit of consumer retail names, just not quite yet. So far, it's staples, not retail, but retail, XRT. I mean, they haven't lost the monthly uptrend, right? They're still not too bad there. Utilities continues to be a very, very popular trade. We talked about this for so long in the month of December, saying, look, what we have right now, guys, was a monthly consolidation phase for utilities, right? If you just take a look at this chart, this is why when in doubt, zoom out, right? Nice monthly consolidation of that 12 EMA, and now you're actually getting the expansion. Expansion on what, you might ask? Well, expansion on, so many names that were just out of favor recently, right? So Vistra was one of my top picks for this year. It still is one of my top picks for this year, recovering off the lows. But Next Era Energy, you might remember us talking about it a lot, especially during this beautiful breakout retest or, a cup and handle on higher time frames right there. Beautiful cup and handle on NAE. Now looking for the breakout. This one too has been doing not much for the past few years. Duke Energy as well. Duke Energy off of the consolidation range recently has been moving very nicely. So utilities, if you don't know which one to pick individually, you can also trade the ETF overall, but utilities definitely a very strong trade. Some people would argue that, well, that's because the market's going risk off. partially, but also because of the massive power requirements that these data centers are going to need. That was the premise to enter this trade upon consolidation, and I still do believe that that is the better premise to follow. It also does get helped by the lowering of interest rates, of course, because these utilities companies pay a lot of dividends, and we're talking about comparisons between that and the risk-free yield, so keep that in mind. And real estate, lastly, XLRE, a bunch of REITs. A bunch of boring REITs. This was also on the watch list to start off these sectors and theme for this year. So far, they've been doing all right. Nothing crazy, nothing fancy, but Vici was one of my favorite picks around these lows. It's moving a little bit, right? Some people can reference names like O Realty Corporation. They've been doing very well, right? Triple N, which stands for triple net. They've been moving well off of these December lows. So no substantial gains, but pay attention to real estate. Real estate and REITs could be an interesting area, as they do also offer some substantial dividends too if you're into that type of stuff. And now lastly, XLE, so energy, oil and gas has just been on an absolute tear. This chart looks like SanDisk or Micron or something like that, right? The bulls never even bothering to pull back that much. They gave you one last re-entry here, and then it was kind of off to the races, right? Never bothering to pull back that much, barely even bothering to touch the 12 EMA on their expansion phase. Daily overbought conditions right now, weekly overbought conditions right now, and this is not Palantir. Usually they do not stay that overbought for that long. However, if, similar to XLP, okay, you see some consolidation down into these levels, they could be very interesting for a breakout retest trade around the 48, 47, where we just left off from these former all-time highs. You get a breakout retest like this after 4 years of consolidation, you'd be hard-pressed to believe that, well, we're just going to go back here and then just range-bound for another 4 years, right? The move is done. Well, it's very possible that the move can considerably continue during this expansion phase. Sorry, guys. During this expansion phase, so watch for the breakout retest. Okay, could be very interesting coming up into the next few weeks or so. Now, taking a look at the VIX at 20.81. And you know what's funny? As we've been saying for the past couple weeks, right? There's no real volatility trigger in the markets right now. I mean, some could argue that, you know, it was started off with the Warsh nomination and things like that. But I mean, come on. Like, when we go back to the actual volatility triggers, this was big market concentration and big unwinds after big concentration, right? That was a big catalyst for the market. That was end of October, early November. We were talking about it leading up into it. This one back here was the China tariffs, right? This one right here was the Greenland tariff situation, or tariffs on Europe because the US wanted to acquire Greenland. So in so many other events on the VIX, you can clearly see that there is one big volatility trigger. There's not any volatility trigger here. This is just people buying protection because they're seeing the amount of volatility in the markets right now. So it's kind of like, you know, it's like an after the fact. It's volatility from pure price action with a few key AI headlines here and there, but pure volatility coming in from pure price action and people wanting to buy protection as a result because there's a level of uncertainty in the markets right now caused mainly by AI. So keep that in mind. It's a great opportunity to be selling options in the market right now. But if you're looking to buy any options, just be mindful of that extra volatility that you are currently paying. So spreads, you know, whether you're playing downside or upside in the markets right now, if you want to use a tool that counteracts some of the volatility premiums, spreads, call debit spreads, put debit spreads, right, for your directional bets. So make the best use of those. Moving on further to our metals trade, so gold and silver. Gold and silver right now not doing too poorly. They did that flush off the Russian news over the course of the day, but gold, unfortunately, just not able to break out. You remember we were kind of referencing this area right there. They were trying to break out 50-50 up to about 50-75, this little range right there, trying to break out, and they had it going for them by a couple dollars. Unfortunately, not enough, right? So the bulls are still looking to continue this sequence of a daily uptrend right now, and the trade remains, right? If you're bullish on gold, it's offering you a good entry opportunity right now. You do not have the daily uptrend break just yet. You have a tradable low right there at 46.37 roughly. This would be a stop loss level if you're looking to continue the daily uptrend higher. But please trade these things with the stop loss because the unwinds can be very brutal. The bulls still control the daily timeframes for now. They still control the weekly timeframes for now, and the monthly still is in control too. But obviously we know that several of these timeframes, namely the monthly, is in overbought conditions. You are trading in overbought conditions right now, so just be mindful. That's why I say you got to trade with a stop loss when you know that things are very overbought. Moving on to silver right now. Silver had a 10% swing today, massive swing overall. Volatility in silver continues, and as you can see, contrarily to gold, right? Well, silver doesn't actually have that same pattern. Silver is still on the quest to establish a daily uptrend, which is what gold did barely, right? Silver never did it. It's just been a downtrend, lower high, and then you don't know. Are they going to go for the lower low? Or are they going to change the trend? Well, if you're taking this trade based off of gold, your estimate would be that they're going to change the trend. Stop loss on any longs right now has to be below here. The last thing you want is to be unwound by a volatile move in silver, and you are going for expansion. The expansion will all be all the way back to the all-time highs, although they do appear to be a wide distance away. You would be looking for the whole cyclical commodities super cycle trade to be back on the table, but just trade this one with a stop loss if you can, guys. If not, it's never fun being unwound, especially when you are in the context of a little bit of monthly consolidation right now, which at the worst could possibly take you down to the 12 EMA. And don't say it's not going to happen. It happens all the time on silver when they do come down, you know, huge move up and they just sideways back test the 12 EMA. You might say that this time is different. And it very may well be, but you know, you can also trust historical probabilities too. Moving on to Bitcoin and Ethereum. I mean, there's nothing much to say here, right? Continuously out of favor, Bitcoin and Ethereum. It seems for every green day, there is like 5 red days in a row. And this is once again the case. So no trend control whatsoever, daily downtrend, weekly downtrend, monthly also unwinding, not a downtrend yet. That would be lower high into lower low, but still no favor for crypto right now, absolutely whatsoever. So that being said, next area of support to the downside, 60,500 and 60,500, that is down to about 55,000, 54,000 is your next area of support lows. And those are significant levels, guys. Those are the highs from 2021. So please keep that in mind. A lot of price action in this current level. You can see we're battling with 73 down to 67. And then the lower one right there, 60 down to about 55. So there's nothing really to do on these crypto charts right now. The only speculative trade without changing the time frame, like gold right there, is you would go long here with a stop loss below there, but that is a completely counter trend trade. I do not recommend it. It's very speculative. The only thing arguably you can do on Bitcoin and Ethereum right now is accumulate for longer term positions, but it may take a very long time because you don't have the daily uptrend, you don't have the weekly uptrend, and the monthly moves have almost given back everything. So it takes so much money and so much time to get all these trends back. So please keep that in mind, which is why I say any buys on Bitcoin and Ethereum right now, you got to have a very long-term thesis for your time frames, guys. If not, you may be disappointed with the momentum and the speed of the move, right? So temper your expectations, please, on crypto right now. That's everything for your overall market rundown. Hopefully you guys enjoyed. Now, we got to talk about big tech, and then we got to talk about the biggest gainers and losers of the day, right? And so as we embark into the big tech list right now, I'll leave you with a quote from Peter Lynch, okay? One of the greatest, the GOATs of all time, right? In his book, One Up on Wall Street, which is a very good book, by the way. I highly suggest you guys read it. The stock market demands conviction as surely as it victimizes the unconvinced. I'll read that again. The stock market demands conviction as surely as it victimizes the unconvinced. What he's talking about essentially is that you will oftentimes be pressed because of price action or because of narratives to sell some of your favorite companies in the entire world that you thought you had true conviction in, but then the price changes and you start having some doubts on your investment thesis. So now is a very good time to review your investment thesis as to why you may be invested in some of these companies on this list. Okay, and now's the time to have true conviction in them overall, right? Now, once again, this goes out to the long-term investors in the market. It has nothing to do with trading or things of that nature, but when we take a look at some of these names and some of their declines that they've been having recently, yeah, there are some very nice opportunities in the market to be buying the dips on some stocks in which you should probably have very high conviction, at least in the long term, right? Short-term price action, as we always know, can be very irrational, but the long term does require high conviction in some of your favorite bets. So please keep that in mind as we move through this list. So moving into the list, guys, Apple down 5%, no news whatsoever, violent price action. Apple woke up and shows violence, and once again, it's these big sell-offs right at the open, right? You can clearly see very inorganic selling, very, very, very inorganic selling, very big algorithm trade right there. Just when you see something, especially on the 5 minutes, never even bother a lot of the times to test the 12 EMA throughout the day. That's just all alongs just being swallowed by a lot of volume algorithms right there, right? Just bringing the volume, bringing the speed, closing out a lot of positions, just going right through the order book as if it's not even there, yeah? So Apple losing a lot of ground right now. And as we can see, right, they tried to go for the breakout, double top, fail, and now rejection. So daily downtrend on Apple, losing the area that they were trying so hard to claim, which is 275 down to 267. That will remain resistance for now. Next off for Apple, 257 down to 246 support. And keep in mind, right, the weekly not looking the best. So high, low, lower high. We will see if the Apple bulls are able to save this into some form of a tightening range, or if they just blast, excuse me, if they just blast through 255 to 246 as if it's not even there. So next stop for Apple is definitely down there too. Now, Apple, even though it's a very high conviction stock for me, you always got to be mindful of what you're paying for this company, right? The last time it was a nibble for me was in the 250 to 245 range. That would be the same at this point in time, as the monthly time frame does show a very nice movement here in terms of a longer form, higher low effect for the business right there. But we got to be mindful, guys. At 270 where it just was, it was expensive. Now, Apple's a very strong company, but for me right now, it is a hold. It's not a buy, it's not a sell, it is just a hold. Thesis for Apple remains unchanged. However, we always got to be mindful the premiums that we're paying for this company, and at 2.7 at a 3 peg, that's just a bit too high for me, so it is a hold for me currently. Moving on to AMD right now. AMD, 3.58% to the downside. Once again, rejection from 230 down to about 216. If we do revisit the lower lows, you guys know the drill, right? 200 psychological, this yellow line has been an area that the bulls have defended, but if the momentum is too strong, you may actually see them start to crack down here, 190 to 180. That is my favorite area to buy AMD overall. The weekly time frame shows no momentum. All momentum has been lost by the bulls in spite of very strong earnings from the company, and still in the context of a bit of monthly consolidation. Dare I say, if they close a monthly candle below 200, it would be a bit of a monthly downtrend, and as a result, you got a quarterly pullback. You very rarely see me reference the quarterly charts, but be mindful, guys, of this pullback. If it gets really bad out there in the markets and you do revisit 190 to 175, let's call it, phenomenal opportunity for this company, because the conviction behind the thesis has not changed. The only thing that's changed is the unfavorable price action. It's still trading very cheap down here around the $200 range. And additionally, we know that the longer term thesis for the business also has not changed, right? If the thesis is intact and the forward projections are intact, all these analyst price targets are clearly above the current stock price. EPS growth rate is huge. Revenue growth rate is massive as well for the next few years. 35% revenue growth on average, 35% EPS growth on average. So these estimates will be maintained. The AI build out is very real. The money is very real as well, right? So if they just give you a better price, well, you know that you're getting a better entry for that thesis. So keep that in mind. Moving on to Amazon right now. Another example of this, right? One of my highest conviction names in the market right now. However, if you look at the price action, you may think that this company is doing something wrong. Not doing something wrong. One may argue, yeah, but what about the $200 billion in free cash flow? Yes, absolutely. But all the capex that these companies have spent in the past 2 years, have we not seen their cloud businesses grow at record levels? Have we not seen them able to improve operating margins on these segments as well, on these cloud segments? Of course. So it does lead you to believe that the incremental dollars that these tech companies are spending to grow their cloud businesses are dollars well spent. Where was money not well spent in recent history in big tech? Well, you just look at Meta and the metaverse. Every dollar, the dollars that they plowed into the metaverse still to this day is generating them minus $4.5 billion every single quarter. That's not the case for a lot of the hyperscalers, and it's not the case for Amazon either. This is Amazon's business model. They've always reinvested in their business when they see opportunities. And from the earnings call, you might remember when we presented it, right? Not all of the $200 billion is going specifically to AI. It's being used to fund a whole host of other projects that Amazon is working on as well. That's been the case for the company for the longest time at the current point, right? Daily oversold conditions on Amazon. Daily downtrend now does continue. Lower lows are in effect and coming down right now into our next area of support, which is 200 down to 190. To say that I'm buying the dip would be light. I am definitely buying the dip right now. There's a one little gap remaining to be filled right down here at about 193. We will see if they actually execute that and come down and fill it. That being said, under 210, forward price earnings 27 and a 1.35 peg. The long-term thesis of this business has not changed. The only thing that has changed is the short-term price action. You're picking up Amazon, daily oversold conditions, decent valuation, 200 psychological price, and a revisit of the 26 EMA, which Amazon does not do very often in the context of overall bull market. So please keep that in mind. And who knows, if they drop down here under even 190, go down to 180, guys, I will just keep buying this company, as I do believe the next 5 years for Amazon are probably a no-brainer in that respect. Moving on to Google at the current time. So Google down 0.63%, not very bad, but you saw that monthly time frame, right? If you flush these post-earnings lows, then the daily bears retain full control of this chart right now. You're under the 50-day EMA, which Google has not really done since June of 2025. So suffice to say, this time is different. The price action is indeed telling you as much. The weekly time frames also full consolidation mode. RSI curling over, and we were telling everybody on the channel about that, right? Be very mindful when you see the RSI very overbought, such an exponential parabolic move to the upside. The MACD was starting to curl over, and now it's curled over. The weekly is crossing below the 12 EMA, something as well that has not happened since last June of 2025. So when you look at this monthly chart, same concept, right? All these parabolic moves eventually all end up in a phase of consolidation. And if Google somehow makes its way back into the high 200s, right, that might be another area where we could possibly nibble and buy the dip. I'm not that interested right now at 310. The valuation is still a little bit high, but bring it down a little bit more, bring it down another 10%, and then we can talk. At that point, Google, if we do make that correction all the way down there, 20%, very nice area, 20% off the highs, tagging some of our technical areas of interest, basically being a backtest of the 12 EMA. But Google, not interested up here. I'm not selling any. I'm not buying any. I'm still holding. Why? Because the thesis of the company has not changed. This is just normal price action. Moving on to Meta right now, another example of a phenomenal company where the thesis remains unchanged. Meta is still a phenomenal company growing revenue and EPS at fantastic clips, a very highly profitable company guiding for 30% growth. But we saw they give back the entire earnings move, and now the daily looks like it does want to embark into another phase of a downtrend. So we'll let them kind of work through it. 644 to 630 is the mark. There is one last little gap down here around the 600 range, and it's been a while, right? Well, it has been a while, but it's been a while that Meta has had some expansion. And I say it hasn't been a while because they had the earnings move, right? But virtually, let's just say it this way. Meta has been down here for the better part of the last 4 or 5 months. We've been able to buy Meta down here, 660 down to 600 range. And I still do think that's a phenomenal opportunity range at 660 or lower. You're trading at very low forward price earnings of 22, a 1.17 peg. Meta is not an expensive stock. So if you are looking to hold this stock for the next 3, 5+ years, these are your chances to buy. Now, for swing trading purposes and whatnot, clearly the bears control all the major time frames on most of our big tech companies, which is why, in terms of long-term buyers, we should be stepping in right now. Not so much for short-term trades. Those have been unfavorable and off the table for a long time. It's been a while that you guys have seen me reference any short-term trading ideas because the SPY and the QQQs have been very choppy for a better part of the last 3-4 months. We've been more focused on either leap call contracts with deep 2027 expiries, December 2027, or long-term shares. Those are the two things, in my opinion, that will favor people at this current stage rather than trying to time bottoms or rather even trying to short into big volume into already crushed valuation. So please keep that in mind. Meta not looking too bad right now, but on the weekly they're giving back a lot of that earnings print, of course, as we can see. And on the monthly time frame, I mean, certain of you would reference possibly the prophecy, right? The head and shoulders. And if we do fall down there, it is coming right back down to 600. This would be an insane buying opportunity if they revisit that location again, similarly to the 2 times they did it prior when we touched those lower 600s as well. So I will be buying Meta. Conviction level stays very high for me. It's just the price action has been wildly unfavorable, but we cannot say that this stock is expensive right now, which is the case for most big tech companies out there, right? Microsoft, same concept, down 0.63% today. Again, not quite continuation of the daily downtrend, but still very close. Line in the sand, 393. We will see if Microsoft bulls have it in them. If tomorrow can be a nice day of market recovery, and they can reset the daily uptrend into next week, well, then you have the start of something nice, right? You have the start of a weekly bounce, and then at that point, you might come into the 426 up to 450 level. If not, and we continue dropping a little bit, well, we're coming right back down here into the end of support, which is basically 385, which would be the 200 weekly EMA. Has it ever been a bad time to buy Microsoft at the 200 weekly EMA? Not on that chart for the last 15 years at least. And around 410, guys, where's the valuation, right? It would be one thing if Microsoft up here, or down here rather, at 400 would be a 3 peg and a 40 times forward price earnings. That's not the case. Mid-20s forward price earnings and a 1.34 peg. So the valuation is good. It's just the price action is bad right now. Weekly oversold conditions, oscillating, daily oversold, and not. So I am a buyer of Microsoft down here. Long-term thesis has not changed for me. As we said, right, most of the money they've been investing. I mean, have we not seen Microsoft Azure with ridiculous growth numbers up there and better operating margins for the cloud divisions? That's the whole point, right? Moving on to Netflix right now. Netflix just getting absolutely destroyed. It seems as though we were correct in saying the next stop for this stock would be the 200 weekly EMA. Right down into it right now. Netflix is currently trading at a RSI on the weekly time frame right now of 23. Last time that happened was really the depths of the 2022 sell-off. And before that, you would have to go back to 2011. To find RSI levels on the weekly this cheap. Suffice to say, Netflix is very cheap right now, but wildly out of favor because of the Warner Brothers Discovery deal, et cetera, right? So that being said, around 75, just take 10% off this valuation. You're now trading at a forward 23. You're now trading at a forward of 1.2 peg on Netflix. A phenomenal buying opportunity, but not for the short-term trader. Why? Because the short-term bears control all time frames. Daily oversold and daily downtrend. Weekly oversold and weekly downtrend. 10 straight weeks, 11 straight weeks of selling, and monthly as well, right? It looks like there's just no end in sight. If you somehow crack below 75, you're going right back down to 70, which would strangely be the highs of 2021. So how far this stock has fallen because of sentiment surrounding that deal, but also probably getting caught up in recently. You may have seen the video of Brad Pitt and Tom Cruise fighting after one of the Chinese models released a new AI video generation platform out there. So maybe Netflix falling because of that as well. So once again, another company that is just getting hit from all sides because of the deal and whatnot. But so far, pure bearish price action right now. 75, decent, but this is just the type of trade that as we dip, if you're looking to buy and invest in this company for the long term, the prices are getting very, very fair down here, in my opinion. That being said, moving on to NVIDIA right now. NVIDIA 1.64% to the downside, trying to come back into the 185 to 178 range. Earnings, 25th of February, should be very interesting. We will see if NVIDIA is able to keep it up or if even they get dragged back down to a location they were just about a week and a half ago at this point in time. If they crack that, they're coming right down again to 171 to 165. Still, further accumulation on this stock, no notable price action to speak of, and further monthly consolidation as well. If we get another back to the 12 EMA, you guys know what to do. It's a great opportunity. Picking up NVIDIA, thesis for the long term definitely has not changed. And if anything, the CapEx issued by Big Tech should give you a good idea of what NVIDIA's guidance should be for this year, right? It'll probably be very strong at around the 175 area if we pull back down there, low 20s multiple, a one peg. You guys know the drill. NVIDIA is fairly cheap right now. So many companies, right? Whether it's AMD, whether it's Amazon, whether it's Google, or not Google so much, whether it's Meta, Microsoft, Netflix, NVIDIA, a lot of them trading at very low multiples right now. Very low multiples. Moving on to Tesla right now, a company that's not trading at low multiples, but had some good price action coming out of the recent lows. Well, they unfortunately suffered the same fate as the rest of the market, down 2.62% today. Next stop for Tesla, again, is 406 down to 385, so keep that in mind. Daily bulls tried, but maybe just too little too late, maybe just getting swallowed by the rest of the market. So if you do revisit that area, they desperately need to hold it. That's where the 12 EMA is sitting. It's the highs from, oddly enough, December of 2025 and 2021 as well. So we will see if if Tesla is able to find its base of support right here and go for the expansion trade. No swing trade on for me for Tesla right now, and also not necessarily buying any more up here, but the chart doesn't look as bad as many other companies out there, right? So Tesla right now down from the highs. It's only down about 16%, only 16%, but you would expect in a market like this, that's being so unfavorable to so many other companies, Tesla being a higher beta name than all of them, you might expect Tesla to be down like, I don't know, like down here like 350, like 27, 30% from the highs, but no. I guess the promise of the robo-taxis, the Optimus robots, the energy business is enough to keep Tesla in favor of the AI trade, right? Moving on to Palantir, even though they said too that they're spending a lot of CapEx this year. Moving on to Palantir right now, down almost 5% on Palantir. So this one too, a pure play AI name. Pure play AI, unfortunately, coming down with the rest of the market. Some people would argue that that's because the valuation was always very high, and a lot of people took profit into this year to rotate into different things and waited for the beginning of the year to do that, to defer the taxable gains into the next calendar year. Yes, absolutely all those things are indeed correct, but it's very funny that Palantir is getting dragged down with the software narrative, being one of the companies that is supposed to possibly put some of those businesses out of business, right? So that being said, on Palantir right now, next line of defense is down here, 129, where we just are, right? 130 down to about 115. So please keep that in mind. The valuation of Palantir right now at about 130, 135 is currently at about 2 peg right now. They're growing revenue and EPS at ridiculous clips for for the next few years, ridiculous clips. And as a result, your PEG ratio is not so bad, but the price of sales is very high. So across multiple metrics, Palantir is very high. But if you are an investor that wants this company for the next 5-10 years, you're coming into some, starting to come into some attractive prices. And dare I say, from here all the way down to 100 would be the area that you might be looking to maybe reload on the Palantir trade should you have taken profits into the 200 range at these highs. Moving into SOFI right now, SOFI down 6%. I'll say, what did SOFI do today, right? Fintech, so many names, guys. SOFI's been down. So many other fintech names have been just clearly out of favor right now, flushing the lows right now. We were talking about this, right? Rejection into resistance 25 to 21. Sadly, this did become resistance for the bulls. It was support for so long, and it was a very big area from 2021 and 2020. And unfortunately, as we were saying, right, in the midpoint of structure right here, there's not too much. It's either they held 20 or the next big area of structure is down here like 17. So it does appear as though SOFI is very weak. The bears are in control of the short-term timeframes. Daily downtrend, weekly downtrend, as you can clearly see from this chart, right? Weekly downtrend not oversold just yet on the weekly. Daily is indeed oscillating oversold. And then also on the monthly time frame, you got a big old monthly consolidation pullback. We were hoping for them to hold this range right there, but the market is just not cooperating, and SOFI being brought down, right? Last year, one of last year's favorite stocks for all of retail, now suffering a very large decline, even though they did have very good earnings, which we did cover on the channels, just not enough, right? So next stop, if you do go for the full retracement, 17 out of 15 range, that's the next DCA. You might remember me saying that my first bought a little bit of SOFI at 20 with plans to DCA down here if it does come down to it. So it looks as though I might get the chance to do that as well. Moving on to Uber right now. Uber up about 0.3%. Awkward to see Uber up this morning, but still not a bad day. So clear bear control right now, right? Clear daily downtrend for Uber. So once again, a lot of these stocks have to prove it to us to reverse the time frames because they're all in daily downtrends, weekly downtrends, and very large monthly downswings overall. So Uber has a chance to protect these lows around 70 psychological, which is the top end of most of this previous resistance range, which is acting as support right now. If they lose it, similar to SOFI, you're coming right back down here to the mid 60s. Now, the valuation has never been a concern for Uber, right? 75 bucks, you're trading at a forward price to earnings of 22, a PEG ratio of 1.11. So you're not paying a lot for Uber's very good revenue and EPS growth, and their earnings were very solid. No slip-ups there, and definitely not being challenged by autonomous vehicle numbers. If anything, their integration of autonomous vehicle networks is very powerful, right? But once again, it's the sentiment, it's the narrative. So Uber, I am starting to buy a little bit. Haven't bought any Uber in my long-term portfolio in a very long time. Matter of fact, was like the past 2 years down here in the 60s. I've been waiting. So nibbling a little bit here at 70, and then the next nibbles will come down there in the 60s locations. And now lastly, Taiwan Semi, which was kind of holding up the market. I don't know what this candle is, but that candle isn't real, but they held up a lot recently. If they pull back, guys, you might just be heading down to this former area of consolidation. I apologize, the lines are crooked. 350 down to 340 would be that location of consolidation. And overall, too, maybe just a bit of a weekly pullback if TSM gets dragged down in the mix. Super solid company, nothing bad to say. Matter of fact, there was some news on TSM, which I did not share today, but Taiwan Semi investing like $85 billion total into U.S. infrastructure assets. $20 billion of that will be investments into the U.S. grid for energy purposes, right? So that was also a very bullish piece of news for TSM, but TSM holding up better than most. Daily uptrend not lost, weekly still in an uptrend, monthly still well underway. So TSM has one of the better charts out there, but maybe not immune to the overall sell-off if it starts really hitting more aspects of the market, right? So far, TSM has been doing a very good job. And at 340, where we just were, I mean, add 10% to this because now we're at 370. It's a 28 forward PE. It's about a 1.5 peg right now. So not the cheapest stock in the market, but you also can't say that TSM is very expensive. So any meaningful pullbacks here to, let's say, the lower 300s, if they drop TSM as well from the highs, 20%, that's when you probably might find me shopping a little bit for some TSM, but no new buys for me right now. It's just a hold. Conviction level the same. For me, nothing has changed with the fundamentals of the business. I'm just not buying anything up here. I'm not selling anything up here. I'm just holding. So that is everything for your big tech rundown with an emphasis on conviction and the long-term thesis of many of these businesses and just comparing and contrasting it with the very unfavorable price action. The moral of the story across most of the names we just covered is that the bears control all the short-term time frames. They control the daily, they control the weekly, they control the monthly. Now, instead of guessing where the actual bottom is going to be, you have to let them show you, right? I'll just take SOFI as an example, but they all look the same, right? When you're in a phase of monthly consolidation on a lot of these names, right? Daily downtrends, weekly downtrends, and monthly consolidation, it all starts with the recapture of the daily uptrends. You cannot say a bottom is in, even if it does come into a support area, because now the narratives are so strong that they're blowing through certain support areas, right? You have to see the recapture of some daily uptrends. No daily uptrends, no temporary bottoms, which is why I say trading, right? I mean, if you're going short off all these pops or whatnot, I wish you the best of luck, of course, right? But if you're just looking to trade the bottom to pick up some calls for the long side, right? You got to wait for the trend reversals. If not, you'll just be swallowed from the other side. So please keep that in mind. So now is a good time for longer term investors to be nibbling on their favorite bets, not so much to be taking some big positions longs and trying to call the bottoms. And if you're net short, well, you guys know exactly what the name of the game here is, right? You just wait for them to crack a support level, back test it, and then you would kind of reload for the next level of downside. So I know not a lot of people are net short in this market, but you guys probably know how to play those anyways. It's just the inverse, right? You're just looking for back tests of support as resistances, and then just looking to carry the trades to the downside into the next levels overall. Just don't extend yourselves. So keep that in mind. Now, that being said, we're now through that section of the market. Now we'll spend some time on the biggest gainers and losers of the day, which there were very many. All right, so let's talk about some of the biggest gainers and losers. AAPL. I mean, AAPL, by the time I recorded yesterday's video after their earnings, they were relatively flat. As you can see, right, they were right about there before getting the extra leg down in the after hour. So when we covered it, it was still around 450, 440. That all changed drastically when the market opened today, down 20%. So we covered their earnings yesterday. Now you're getting a decent discount here. If I were to just redo this valuation for you guys, because all the numbers are very fresh. So if we just redo this, we were saying that AAPL was an interesting look just yesterday, right? Let me just redo it for you guys at 366 in terms of forward estimates. I don't think that the estimates for the price to, or rather the EPS change. I'll just redo it since it's such a drastic change, right? 20%. I wouldn't redo it if it was down like 5% or whatnot. 1542, they actually increased it, so that's even better. 1542, the growth rates should not change that much. So 1542, if you take a look here at 366 divided by 1542, trading at a 423. Or excuse me, do that right? 366 divided by, yeah, there you go. Okay, so 23.73. I know I got something wrong right there. Moving on further, we got another additional piece of information. My apologies, I think I had that number wrong. Right now, you would be trading with that EPS growth rate, guys. That's pretty ridiculous. It's like a 0.6 peg. Very low for AAPL overall. So not that bad for AAPL, truly speaking, right? Interesting company. We covered their earnings yesterday. Make sure you guys check that out. I do believe that I had the price to earnings stale number. It didn't update, so now I had to kind of update it again, so my bad on that. But yesterday we kind of derived that it was a very cheap company to begin with. So you know, if you wanted to possibly start a position down here like maybe 350, 300 for the next few years, not that bad of an opportunity. Once again, my mistake for the bit of an error there in the forward PE as of yesterday's video. I think it just didn't update that number overall, but I had it reflect a little bit in the below numbers. Moving on to the space trade right now. Space trade, ASTS down an absolute ton. Space trade, this one, Rocket Lab, etc. Rocket Lab, I truly do enjoy it down here, like in the whole 60 to 50 range, closer to 50 if possible. Now, this one doesn't have the cheapest valuation at all. We're still waiting for the Neutron rockets, but if you ask me between ASTS and Rocket Lab, I probably would have a penchant towards Rocket Lab overall, just because they are the delivery mechanism, right, for all the satellites in space. They also offer so many different parts to the space trade overall for various aspects of rockets or whatnot, whereas ASTS is just a constellation of satellites, which is very interesting as well. But if you had to ask me one of the two which might have the most longevity and the higher competitive advantages, probably Rocket Lab in my opinion. So I'll be waiting for that one. If we pull back 60 to 50, you may even see me start a longer form position. Now, the critical minerals trades are also getting unwound left, right, and center. You may see that the USAR has just unwound the entire US deal that they were kind of given. in terms of the direct investment or whatnot. So USAR, some of the critical minerals, guys. USAR, this one also is a multi-year trade because we know that it's going to take them a while to scale their operation. So USAR, once again, the range remains between 16 and roughly 13 to the downside. If they do revisit that, you're looking to build a position, not too bad, but it is not for everybody, of course. Affirm is just blasting through every single support level that the chart actually has on deck. If you take a look right here, we did their earnings just recently, right? And we saw that in terms of the PEG ratio, they're growing EPS so fast, price to sales is super cheap. So even if you do believe this EPS growth rate will be coming down over time, which it will, just the law of large numbers, right? The PEG ratio is good. Price to sales is even better up there at 55. So next stop for Affirm, 46 down to 40. This as well is a position to consider for a long-term portfolio if you want to take advantage of the buy now, pay later niche. I think Affirm has the best product in the market for that. Do they deserve to be down 12% today? Probably not, but fintech suffering heavy blows all across the board, right? Take a look here. I mean, ALAB, the other ones, we covered them just the other day. Bloom Energy, a very popular trade for fuel cells and whatnot. It's up a ton this year so far. One thing's for sure, if I can somehow find Bloom Energy with a big sell-off overall down here, again in the $100 down to $80 range, this wide little pocket of price action with their technology, probably going to be very interested, right? That would require a very steep sell-off, but you guys know me, 12 EMA, which is going to be something that I do target. So if Bloom Energy is not immune to this sell-off, and they do give back a good portion of their market cap, you may find me interested down there, but not up here for now, just the way that I like to do things, buying things on significant dips. If we take a look in other aspects of the market, right? Lemonade, we were talking about this one for a while when it was peaking around the $95, $100 range, and I was saying that, if I'll keep it on the watch list, and if ever I can find Lemonade back here in the 50, let's call it lower 60s down to about 45 range, I'd be a big fan of playing that range. And lo and behold, we are like almost right back there now, right? So keep that in mind. Down tremendously here, 40% since just the highs that we had the 22nd of January. So I would be a big fan of Lemonade down here in the mid 50s to start a position for the long term. I think the company is very well positioned to capitalize on that insurance trade using AI, of course. So keep this one in mind. T Energy is one of my largest small cap positions. And of course, it's round tripped a significant amount of gains. Long-term thesis hasn't changed. My conviction level hasn't changed, only the price action. So perhaps this whole $6 to $5 area would be a nice area if you were contemplating starting a position to explore this trade. Obviously, do your own research. I presented this company on the channel a number of times. Nothing wrong with the business, only normal price action. They are killing a lot of growth stocks out there, but not even this one, right? Even some of the other space trade ones or drone trades, Ondas, right? People were clamoring to buy Ondas at $15. I haven't really heard people talking about Ondas recently, but Ondas, $8 to $6 could be a very interesting bet as well. So please keep that in mind. Been waiting for that for a while. Just a couple other ones that come front and center to mind. RDW also, people were clamoring to buy RDW around 14. Nobody's not now talking about it around the $7, $8 mark. I will be increasing my position. These are all multi-year holds, guys. There's nothing to do with the short-term price action. They're small caps and mid caps for the most part, right? So they will be excessively volatile. You just have to have a long-term thesis for the expansion of the business, and I think they should do quite well, right? Another one I'm exploring, LightPath, has been brought up quite recently as well, a number of times, 21% with an incredible backlog too. So that one also up for exploration. That one was up 21% today after their earnings, which showed very good things. Names like Path, names like Zeta have just been deathly out of favor recently, coming down so hard after beautiful earnings from UiPath. It seems as though everybody forgets the earnings that they just posted being positive gap. And usually that's what I like to look for, 44% to the downside. But once again, small and mid cap, they will be tossed around, especially since this one is being lumped up into software. Be a company that gives that does robotics process automation. It's like directly AI, EPS nicely improving. And also your revenue stream nicely improving as well. This one, small cap play for me. It's not a huge position, but I do have some, but I'm willing to wait the necessary time until the market also is able to bid these higher. And Zeta, a very popular retail trade, just filling the gap now back down there about $15, falling through everything right now. They have earnings next week. Next stop for Zeta, it pains me to say it, right? It would be like 13 and a half. all the way down there towards this lower bound of support overall. Great company, great products, but at the end of the day, like most of the advertising cohort has been down. Zeta has been down. Trade Desk has been down. I mean, Meta, even Amazon, which is a large advertising division, they've been down too. So a lot of software guys, everything associated with software is just coming clean to the downside right now. A very, very volatile environment for most stocks out there. We can talk about Robinhood again. Robinhood, I mean, don't look no further than crypto. Robinhood down here at 70 bucks. It's fair value, guys, in my opinion, right? It's very, very fair price for Robinhood down here at these $70 lows. The only problem is there's no support. Look, I'll put a line to where we are right now. There's no support. There's nothing here. There's really nothing there, right? Next big area, big is a very, big's a big word because there's not really much there anyways. To be honest with you, if you just look at this chart, there's not really much until 65. The bulls just didn't bother setting anything on the way higher. So it's just free falling right now, just being way too correlated to crypto, which is unfortunate for the business because they're working on so many other things. But if you were always looking for an opportunity to buy Robinhood and you just never participated, maybe now through like 60 and even 50s could be your chance to accumulate this company if you're looking to hold it for the next few years overall. But I know that the price action has been wildly out of favor. I mean, look at Spotify. Spotify just literally went up 15% after the recent earnings. They're giving most of that back. We covered them on the channel the other day around that 480 mark. The PEG ratio wasn't bad. Price to sales wasn't bad either. Not a company I'm investing in, but still just one to keep on the watch list. Shopify, same concept, right? Shopify had beautiful earnings. They were up 13% in the pre-market, and now look how much they're down, right? Giving everything back, all of that, 24% from that post-earnings move. Shopify, covered it yesterday on the channel. Very interesting company, right? Lower 100s, down about 95, 90 bucks. That is where I'll be looking to build a position on Shopify. I started a position on Shopify recently, and I'm fully acknowledging the fact that I may have to DCA this position for the long term once again. Not swing trading, not calls, anything like that. No, buying shares for long-term positions overall. So please keep that in mind. So many companies like Reddit. Reddit had phenomenal earnings. Market just doesn't care, selling them down in a very disrespectful fashion. Next stop for Reddit right now is about 126 to 120, and under that is like lower 100s, right? So Reddit, we made a case for that one too. Solid company, great growth, great margins, but just wildly out of favor in the markets right now. And I think that's most of everything that I wanted to kind of talk about today, right? NBIS, we'll cover their earnings. They had earnings today. They actually managed to finish green on the day. But NBIS and IRN and CIFR, right? It's all the same trade at the end of the day. I mean, there's a few key differences here, but you can tell they just have not been in favor. So these trades are very popular, and any positions built now should be held with a thesis of late 2026, 2027, 2028 expansion underway, right? So the ones that I own right now are NBIS, Iris Energy, and I own a little bit of CoreWeave too, and I am holding them because the thesis for these companies has not changed in spite of the recent price action. So please keep that in mind. Just covering some of the neo cloud builders because I know you guys are you guys like when I do those names overall too, but just so many names to the downside. I don't have time to talk about everything, of course, right? Pay attention to the banks. Banks could be very interesting on the revisits of their monthly timeframes. Bank of America under 50 down to 48. Very clean chart in my humble opinion, just looking for the good old breakout and retest. JP Morgan also just looking for the breakout and possibly retest of the lower 290 to 280 region, the 12 EMA. So many nice charts, guys, on the table right now for either breakout retests or just buying dips on some of these high quality companies because of their valuations. So please keep that in mind, right? Some of the defense trades that everybody was clamoring in late January, so to speak, or mid-January. KTOS giving everything back. Watch this whole 70-77 area. That could be an interesting location if you've always wanted to have exposure to KTOS. AVAV, same concept. Nothing's wrong with the business, but the narratives recently have shifted on this company too. 233 down to the lows of, let's just call it 200. I'll just put a little box there so you guys understand what I'm referencing. This little area right there would probably be the area that the bulls will be looking to maybe build a base of support into. You can see it best on the monthly time frames, 26 EMA or whatnot. Evaluation down there at 200 is a lot more compelling, so that's where I'll continue to build a little bit of my position into into AVAV. My first buy, a tiny buy, guys. We're talking like $1,000 buy. I want to bring this one up to like a $5,000 position for me. My first buy was here, $1,000. So now I'll be kind of increasing the buys as we move through these 200s, and then I'm just holding for the next few years, looking for the thesis expansion just because of conviction overall, right? But the list, I mean, Airbnb has their earnings too, or they had their earnings today, right? Airbnb moving nicely after their earnings. Airbnb for me down here, 120 down to 110. Clean area, in my humble opinion, guys. It's been years and years and years worth of support. So this is one of my long-term holdings as well. And I think that pretty much covers most of the stuff, right? I'm going to spend some time on the biggest losers of the day because I'm pretty sure that's what you guys want me to spend some time on. We talked about the biggest winners of the day when we covered the rotation earlier on in the video. Just a bunch of value names on the highs, right? It's all you can kind of see here. Brookfield is one of my newer positions as well that I was accumulating down here in the $45 range. That one's been moving okay. Some of the oil stocks, one of my newer positions as well. And I never really buy this stuff, guys, but I bought it for data center purposes. Midstream oil was going to be very popular, and Enbridge just had a very clean chart overall in terms of some expansion. So I was able to pick up some Enbridge down here, and now we're kind of looking very good on that one too. So, you know, just a lot of very boring companies on the highs right here. SPGI, shout out to them. You guys already know my thoughts there. And Grab had earnings as well. Grab is one of my international stocks. It's just been wildly out of favor recently. I will be increasing my position down here all the way through the under $4 range, which seems to be the very large area of resistance from the past few years. Sadly, they broke through the $5 range, right? Most of my initial buys on Grab were like in the $4 and $4.50 range. We're kind of under that now. So my next batch will have to come into the fours, and I'm just kind of riding overall. Not a very large position for me, but definitely one of my international picks, and Mercado Libre being the other large international pick that I have in my portfolio. 2,000, in my opinion, is a no-brainer buy. Very strong earnings right there. Very cheap valuation as well. If we somehow visit 18 to 17 again, 200 weekly EMA, definitely must believe that I will be buying more shares of Mercado Libre down there. So there's phenomenal buys out there in the market right now, guys, depending on where you're looking. And you'll notice that I didn't really say I'm not buying any software. I'm not buying Salesforce. I'm not buying Adobe. You know, I'm not buying ServiceNow, even though they can be compelling, you know, mean reversion trades right now. I just think that software is going to be very confusing. So the only few little software names that I have are UiPath, even though it's not, you know, it has more AI than it is software, and Zeta as well, just because they're such low market caps that I do believe when you have a bit of mean reversion come back in software, I think those have the best chance to run quickly to the upside, as opposed to trying to get quick upside in a ServiceNow, which is like a $108 billion company. But you know what the problem with these software names is, as I referenced many times on the channel so far? The problem with this software narrative is that when does it stop, right? They've been posting great earnings. The market doesn't care. But what I mean by when does it stop is the LLMs are going to keep pushing out new updates, right? So like you may have a period of reprieve here on these software names, but then in a month, you know, ChatGPT is going to come out with a new model, or Gemini is going to come out with a new model. By the way, they just came out with a new model today, which posted very strong numbers. Claude is going to come out with new plugins, new things to work on, new disruptive factors, right? Which is why software is just so tough. I mean, can it possibly recover to mean reversion? Yeah, but software, like I'm personally not, maybe I'm wrong, but I'm not expecting this in software. You know, maybe we can have mean reversion from absolute destruction, but could software stay muted for a long time as you just move through these various news releases from AI? There's a very distinct possibility that the answer is yes. So like some of the favorite trades for the market right now is still the infrastructure side of the whole trade, right? Construction companies, energy companies, things of that nature. And those are the ones that I'm keen on playing more. You know, I'm playing some little small software names for a bit of a mean reversion trade, being the fastest horses in that race, in my humble opinion. But am I picking up any software companies for the long-term portfolios? Well, the answer, unfortunately, is no, because we've just lost a lot of visibility in earnings. And I just don't think that this news cycle surrounding AI is going to stop around these software companies, especially not legacy enterprise resource software companies with tens of thousands of employees and high subscription model businesses, right? It's just not going to stop. Now, I don't think that they're going to be disrupted overnight, but it's their share price, right? Can they stay down for a long time? quite possibly so, which is why I'm not rushing into these names and building long-term positions in these names overall. I'd rather just focus on all the other companies we've talked about so far, you know, some of the defense, some key themes for the next few years, right? Space, energy, defense contractors, things of that names. Those are my newer positions that I've been building in the portfolio. Not so much software, and also just rebuilding, or rather further building positions in my favorite longer term holdings, whether it's Uber, whether it's Airbnb, whether it's some of the Mag 7 names, whether it's SPGI, whether it's Visa, whether it's MasterCard, things of that nature, right? But not specifically going for some of the ServiceNows, the Adobes, the Salesforces of the world. But that's just me. So that being said, guys, that's everything I had for you guys in today's, oops, that's the Discord. That's everything I had for you guys today in today's video. Hopefully you guys enjoyed. If you did, consider dropping a like. Would appreciate it for the growth of the channel. Consider subscribing if you're new as well. We do these videos every Monday to Thursday while I'm traveling, but when I'm home, Monday to Friday. And last but not least, if you have any questions, please feel free to leave them down in the comments. Any questions, comments on the AI narratives, what you guys are looking into trading, I would love to hear from you guys down in the comments section. And that's it for me, guys. Won't be seeing you guys tomorrow, so I hope you have a good Friday session, CPI release tomorrow. And hopefully you guys have a good weekend as well. And hopefully throughout the weekend, you are also able to build a list of high quality stocks that you have conviction in, right? Possibly some of the ones that best serve the themes of 2026 and further, which we talked about. If you're confused about what those themes are, just go watch some of my videos from earlier in January. A lot of them are titled 2026 themes and sectors and stocks to pay attention to for this upcoming year, because these themes are not going to change, right? A lot of the energy themes, right? A lot of the energy themes, right? Whether it's nuclear or just oil and gas or just electrification themes, right? Solar, things of that nature, whether it's basic materials, critical minerals trades, whether it's defense corporations with all the military budget spending increases or whatnot, and the, digitization of the military, a lot of new drones, a lot of new technology, right? Edge compute is going to be another very big one as well to pay attention to, and things of that nature. And then, of course, you have these second order AI plays, the data centers, right? Everything inside the data centers, whether it's cables, whether it's thermal, whether it's liquid cooling, fiber optics, things of that nature, right? These are the key themes that the market has been favoring, at least over the last month and a half. So please keep that in mind, with a little bit of a kicker towards dividend names because of the cyclical rotation. Now that the market has better visibility into the macro, more rotations into consumer staples and just overall dividend names, which you can capture with the dividend fund, that most dividend funds have been moving in like 3-4 years at this point, right? With a little impact on international exposure as well, if you guys want that too. So a lot of things that we discussed in today's video. Hopefully I helped you make sense of it all. That's it for me. Take care. Have a good one. Peace.